Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Global long bonds are slumping on worries over developed market budgets and a rush of corporate debt sales. The U.S. 30-year yield is climbing towards 5%. President Xi Jinping parades China's military power and diplomatic clout with a display of its latest weapons, with global leaders including Putin and Kim Jong-un in attendance. Plus, Turkish assets plunge after a court orders the removal of the main opposition CHP's Istanbul administration. Well, it's just gone 8 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. What a global rout yesterday for stock markets and for fixed income, with the U.S. back online again, back to school or back to markets, back to trading. Monday, Labor Day, so we had quiet activity. Yesterday was quite the return. A huge pullback in Wall Street, starting off the day in negative territory for those major indices. And, of course, so much attention on fixed income. But let's just look at the screen now, because what you are seeing is some stabilization coming through. S&P futures leaning towards the green once again. Nasdaq up 0.2%. Some after-hours positive news coming through for Alphabet after a court decided that Google will not have to sell its Chrome browser. So the stock was up 7-8% in after-hours. So that's going to give a bit of a boost to the Nasdaq in the U.S. session later today. European markets also seeing a bit of a turnaround, up 0.3%. Yesterday, we did end the session down 1.4%, so a deep day of losses. But again, the theme is one of stabilization. And the UK, so much focus on the UK market action yesterday, but things there too stabilizing after the pullback of almost 0.9% yesterday. Let's switch over, though, and take a look at some of these global fixed income markets, because we did see a massive repricing higher. A lot of attention, as I just said, was on the UK and the fact that gilt yields there are not at levels seen since 1995, 1998. The 30-year UK sitting at the highest level since 1998. UK borrowing costs now the highest in the G7. A lot of focus there on the fiscal outlook, in addition to that upcoming autumn budget review that's going to be coming up in a couple of weeks' time. So that's going to be key for direction for UK assets. But you can see it's not just exclusive to the UK. You have 30-year yields in Japan up 4 basis points today. Also news that an LDP lawmaker is stepping down, not helping. 30-year yields in the U.S. getting close to 5% once again, so about 2 basis points higher. The curve steepening trend is back. And then the pound also slipping with those UK fiscal concerns. And then euro also slipping a little bit as well. So that is the picture this morning, very much centered on global price action in fixed income. But let's just turn to some of the geopolitics as well, because Chinese President Xi Jinping has appeared alongside Russia's Vladimir Putin and North Korea's Kim Jong-un at a military parade marking 80 years since the end of World War II. Now, in his speech, Xi called on the troops to build a world-class military and defend China's sovereignty and territorial integrity.
The Chinese nation is the great nation that is never intimidated by any bullies and always values independence and forges ahead. In the past, when faced with critical struggles between good and evil, light and darkness, progress and reaction, the Chinese people rallied together to defy the enemy.
Bloomberg's China correspondent Min Lo joins us in Beijing for more. So a really notable speech there by the Chinese President Xi. What were some of the takeaways? And also, given he's saying they will not yield to bullies, can we infer which bullies he is referring to?
Yeah, he didn't name drop any countries, but obviously given the current geopolitical context, China is not engaged in a physical war, but there is a lot of antagonism from the likes of the US, from Europe as well on the trade front, right? And this is really a display of military might, a really majestic display. As I was walking over to the office, Jumana, there were all these people lining up by the sides of the road, trying to get a glimpse of the tanks rolling past, and you can see that all these people, I have to say that this is really a made-for-TV spectacle, because most people won't be able to be present on the ground at Tiananmen Square. So all these people, they were glued to their phones trying to watch that live stream on state TV while they wait for the tanks to roll past. A very highly anticipated event in China. But yes, President Trump, I presume, was watching the parade because he tweeted on X asking whether President Xi is going to thank the U.S. for the massive amount of bloodshed as U.S. supported China to secure its freedom during World War II. But in President Xi's speech, obviously he thanked the veterans for their sacrifices, and it's really part of China's way to introduce its version of history and really highlight the contribution that countries like China and Russia did in this victory in the World War II, that it's not just an allied victory, it's also China and Russia that played a huge part, especially with upwards of 20 million people who lost their lives during the World War II. And he did make a nod to foreign countries. He thanked foreign countries who came to China's aid, but did not name drop the United States.
Yeah, well, it certainly caught the attention of the U.S. president. We just put up that post on Truth Social. Please give my warmest regards to Vladimir Putin and Kim Jong-un as you conspire against the United States of America. So that is how President Trump is framing this. And it has been a show of military force as well. It is ultimately a military parade. What is the messaging, do you think, that President Xi is trying to send to the rest of the world with this great show of military power as well?
Yeah, on the one part, it's the military parade, the hardware. I mean, one of our colleagues, our defense editor, was making an interesting note. He said that you can see these big alphabets on the military hardware. It makes it easy to identify what they are, which shows you that this parade is as much an outward-facing one as much as an inward-facing one. So it is a projection of military power because there were all these new missiles on display. There were combat drones. There were uncrewed optionally crewed ships, amphibious vehicles, all of those would be critical for any attack of Taiwan, for instance. And President Trump also mentioned about how Xi is conspiring against the U.S. with Putin and Kim. Kim Jong-un's presence is particularly notable. It is his first foray into international diplomacy since he came into power. And perhaps by coming here, he's also maybe seeking to elevate his standing and his country's standing, putting himself and his country on par with the likes of Putin and China as a nuclear power, and a trend that is irreversible, especially given that Kim actually toured North Korea's new missile factory just ahead of this trip, and a signal and maybe a snub to President Trump as well that he's going to continue developing nuclear weapons even with this pressure from the West, from South Korea and the US to end the nuclear program.
Yeah. I mean, just pretty remarkable footage coming out there, and we have them on the screens right now. You've got Kim Jong-un and Vladimir Putin front and center on the right and left-hand side of President Xi. The imagery is very, very striking. Thank you for helping us make sense of it all. Bloomberg's China correspondent, Min Lo. Now, bond investors are weighing fiscal concerns across developed markets as stocks also face a historically rocky month. Joining us is Selena Ling, chief economist and head of global markets research and strategy at OCBC Bank. So there's so much to talk about with the geopolitical realignment of the world, as we were just talking about with Min, and then the global sell-off in fixed income. I just want to start off maybe with one question about what we've got out of China in the last couple of days, the military parade, the fact that China is really emerging as an anchor for these BRICS nations, the leader of the global south, so to speak. Do you think that this is going to have any medium, long-term impact on the direction of travel for the Chinese economy and the fact that all of these countries in the East and in the global south have had to band together to find alternative trading partners away from the U.S.?
So I guess, with the polarization of the global economic order and trading order, it is very likely that, you're going to see some divisions into two large camps. The third camp, of course, being the non-aligned nations. But I think, growth-wise, the Chinese will do whatever stimulus is needed to keep growth relatively stable, even if it's just a tad under the 5% handle. But I think the recent developments do show that, soft power and influence is probably something that China will be working on in all the months and years to come. I think that will balance out, all the uncertainty and the global growth headwinds that we are seeing in the global economy. And it's probably a good chance for China to kind of showcase its stability and anchor position within the region.
Yeah. Okay, let's bring it back to more recent market developments. We started off with the intro talking about what happened in markets yesterday. It could be just the case of investors returning back to the market and being stunned by a huge amount of corporate supply. But at what level do you start becoming concerned about how quickly these bond yields are repricing in global fixed income markets, from JGBs all the way to U.S. Treasuries?
I think we have to take one step back. I mean, we've coming out of this summer lull period where there was relative calm, and now all the traders are back at their desk. They're positioning for this Friday's non-farm payrolls. They are trying to weigh between the tariff influence inflation prints, but also a softening economic data prints. And of course, on the back of their minds, they are all looking for a steeper yield curve, mainly because of the expectation that heavy issuance will be needed to basically fund some of the fiscal needs of some of these major powers. So it's not unusual. September tends to be a fairly volatile and challenging month for most risk assets. But it's still early days yet. We really have to see what happens with the FOMC at the 17th of September. We have to see what happens with non-farm payrolls on Friday. We have to see the UK's autumn budget. So it's all about positioning and, of course, expectations going forward.
Is there merit to the argument that some people have posited, though this is a U.S.-specific argument, so it doesn't explain the global nature of the sell-off, but people in the U.S. are saying that one of the reasons U.S. Treasury yields have started to rise is because of the potential foregone revenue from tariffs if courts follow through and deem that Trump's tariffs are actually illegal. Do you see any merit to that argument? Do you think that that was one of the catalysts for the sell-off yesterday?
It could have been one of the contributing factors. I don't think it was the main catalyst per se, because even if the Supreme Court ultimately rules that, the tariffs are illegal under the IEPA, there are actually many other options for the U.S. administration to pursue tariffs, under the Section 232, for instance. So I don't think it's the end of the tariff narrative yet. I think if you look at the global phenomenon in terms of the longer dated bonds selling off, I think generally, there's recognition from the market that, global growth is expected to slow down in this very fragmented trade order kind of a system. But going forward, for major governments to step up on the stimulus pedal, they really have to fund it from somewhere. So, the bond market players will be a little bit angsty. And I think generally, we've had a nice run in this year, as far as risk assets are concerned, equities, for instance. So bond markets have been fluctuating a fair bit because they're kind of like caught between this tariff story, inflation story, and, global growth slowdown and the need for higher funding needs going out into the medium term. So it's not surprising we get a bit of volatility coming into play. And I think, generally it's likely to be the case until we get to the end of the year.
Yeah. Yesterday, we had an interesting chart up on our show showing how economic forecasters have started raising their prospects for Chinese growth in the coming quarters, but have started downgrading their prospects for U.S. growth over the similar time frame. How do you see things panning out and the divergence between the trajectory for the U.S. economy versus Chinese economy?
For the U.S. economy, I guess we are starting to see, the tariff coming back to bite. We've had a weak manufacturing ISM. It does suggest that, manufacturers are starting to feel the weight of the tariffs coming into play. U.S. consumers also may, start to see consumer prices edge up. We've really seen a hint of that in the last month's goods producer prices as well. In contrast to that, actually, it does look like the Chinese economy, at least up to the first half of this year, had relative signs of, stable growth. And a lot of that, of course, was due to, some of the anti-involution measures that they're putting into place. So I guess the differential now between, U.S. and China is quite interesting because there are different factors being at play domestically.
Yeah, so interesting. Selena, always good to have you on our show. Selena Ling, Chief Economist and Head of Global Markets Research and Strategy at OCBC Bank. Now for a look at some of the other stories we're following today. Fed Governor Lisa Cook's lawyer says President Trump's move to oust her is based only on cut-and-paste claims of mortgage fraud in social media posts. In a series of court filings, Cook's attorney argued that Trump lacked valid grounds to fire Cook for cause. He also said social media posts by Federal Housing Finance Agency Director Bill Pulte and a criminal referral to the DOJ didn't give Cook a chance to respond before she was fired. Treasury Secretary Scott Bessent is reportedly planning to start interviews on Friday for a successor to Jerome Powell. That's according to a Wall Street Journal report, which says there are 11 contenders, including Fed Governors Chris Waller and Michelle Bowman. Following the interviews, Bessent plans to recommend a final list of candidates to President Trump. And coming up, Putin scores on energy ties with China, sealing a long-awaited gas pipeline deal. The details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersachi in Dubai. Well, Russia and China have taken a big step forward in deepening their energy ties. Gazprom says it's finally sealed a deal to build the Power of Siberia 2 pipeline to China, a massive project to ship gas east as sales to Europe dwindle. For more, we're now joined by Bloomberg's Stephen Sachinsky. Stephen, really interesting Energy Daily yesterday. That's the newsletter that you and the team write. And you talk a lot about this news, potentially, of that new pipeline being set between Russia all the way to China, potentially opening up new customers to Russia and moving away from some of the dependency on Europe. So really a potential game changer for Russia.
I mean, it could redraw the map of energy trade. This is all part of Russia's pivot east. It's been key for them to find new customers because the European Union will be banning all Russian gas imports by the end of 2027. Europe was once their biggest customer, but now those sales are dwindling down about 90% from when before the war began in 2022. Now, for China, they get dirt cheap gas. It's good for them as well, this kind of deal. Russia is offering gas supplies at a lower price than what they were selling to Europe. Clearly, Russia is desperate. They need a customer. And China, willing to lend a hand, also wants a good deal out of this as well. Now, the details of this are still being kind of figured out. There are numerous unknowns. But that being said, it does show a step forward. It's symbolic in that these countries are joining together in a way that China will depend potentially on Russian energy for decades to come as their largest supplier of gas.
Yeah, so really enhancing and deepening those economic ties alongside the political ties, which we were discussing earlier on in the show. What does this mean for the U.S.'s ambitions to dramatically increase the amount of their own gas exports? Is this going to be problematic somehow?
Now, if this project, Power of Siberia 2, does come to fruition, that will equal about 40 million tons of LNG, equivalent of LNG, per year, in the 2030s. So it's not going to have an immediate impact on the market, but that 40 million tons per year, to put that into context, is half the demand of Chinese LNG imports just last year. So it's a very large number. Wow. Now, again, if this pipeline does come forward, that means that Chinese LNG demand growth, they're the world's biggest LNG buyer, may not rise significantly in the 2030s. And that's important because the U.S. is the world's biggest supplier of LNG. And while right now trade tension has forced China to shift away from U.S. LNG imports, clearly in the future, having a larger market where there are more buyers will be key to underpin a number of large projects that are kind of on the drawing board across the U.S. Gulf, as well as in Alaska, a project that Trump has been pushing forward pretty significantly while they haven't been able to find really any concrete buyers. So the less demand there is for LNG from China, the less American exporters are essentially able to sell and enter the market. Now, again, not an immediate impact in the near term, but it is something in the 2030s, and it is something that Trump has talked about. He wants to own energy dominance. He wants to use the weight behind him, and he wants to continue export growth well into the next decade. And that's something that could be hindered with this deal with Russia.
And let's not forget that so many of those trade deals, those tariff trade deals, also have an energy component to them. Many of these countries committing to purchase more energy out of the U.S. So a very interesting long-term story, as you say. Stephen Sachinsky, thank you so much for bringing it to us. Now, coming up, Kenya faces a long road to fresh IMF support as both sides work to hammer out fresh reform parameters. Details next. This is Bloomberg. Kenya Kenya's quest to secure new funding from the IMF will likely be a longer, more drawn-out process. That's as both sides need to decide on fresh reform parameters. And as a result, analysts see the flow of money to Kenya beginning after the 2027 elections. For more, Jennifer Zabazaja, our chief Africa correspondent, joins us now. Well, Jen, maybe let's just bring in a little bit of context here, because Kenya were in an IMF program. It lapsed in April of this year. Since then, they've wanted to restart these talks with the IMF. But what are they essentially looking to achieve? What is the objective right now?
Right. Jumana, I think it's important to set up that context, as you were just noting there. We have been reporting about the engagement that we've seen between IMF authorities and the Kenyan government. And really, if we take a look at both sides, the goal has been a bit different. If we take a look at the IMF's perspective, they have been talking and engaging with authorities with the goal to assess anti-corruption and oversight institutions within the country. And they say specifically they wanted to make sure that there is transparency throughout the government, and also what they say macroeconomic stability, and noting critical governance weaknesses. They say this is not specific to Kenya, but they do a lot of this and are concerned about a lot of these institutions within a number of the countries that they're focused on. But that is the perspective from the IMF. From the Kenyan perspective, we've heard from Treasury Secretary John Mbadi, who has said critically the government wants tax predictability. Now, what we're hearing from strategists and what they've told us is essentially that it's seeming like a lot of the outlines that need to be assessed may take a bit longer, because there are still reforms that the government may need to introduce. And strategists and analysts are saying it might be difficult for the government to actually push through any reforms, especially if you consider the reaction that we got the last time around, that the government at least tried to institute some tax reforms. And so, yes, what they told us is that a long, drawn-out process is likely, unlikely that we'll see any new program before the 2027 elections.
2027, that is a long time away. Jennifer Zabazaja, our chief Africa correspondent in Johannesburg, thank you so much. Well, let's just take a look at some of these global markets. Given the rout that we saw in fixed income yesterday, massive move upwards. This is where U.S. Treasuries are trading this morning. 30-year yield approaching 5%, or 2 basis points higher. The 10-year yield also approaching 4.3. I will tell you, though, remember when we had that big rout earlier in the year, we got up to 4.6 in 10-year yield. So we're still far away from that. All right, coming up, we're going to discuss more fixed income strategy with Azimut Group amid a slump in global bonds due to fiscal concerns. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Global long bonds are slumping on worries over developed market budgets and a rush of corporate debt sales. The U.S. 30-year yield is climbing towards 5%. President Xi Jinping parades China's military power and diplomatic clout with a display of its latest weapons, with global leaders, including Putin and Kim Jong-un, in attendance. Plus, Turkish assets plunge after a court orders the removal of the main opposition CHP's Istanbul administration. It's just gone 8:30 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. Well, a pullback for U.S. markets yesterday, for all global markets, actually, equity markets. First day back in September. Remember, Monday was Labor Day in the U.S., so investors came back to a bit of a rude awakening, a sell-off in equities, but things stabilizing this morning. S&P futures up about 10 basis points. NASDAQ up 0.25%. As we also keep a close eye on Alphabet, a court ruled in their favor. They don't have to sell their Chrome business. So good news for Alphabet. That stock is up about 7%. In after hours. So something to watch out for in the tech space. Euro markets also seen opening up in the green, despite, again, a huge pullback yesterday, 1.5% weaker on the day. And then the UK, so much focus on the price action in the UK, especially the last couple of days. We did see the FTSE 100 decline 0.9%, but all of the focus was in what happened with bond yields, with long-end UK gilts back to levels not seen since 1998. Real concerns there about the fiscal outlook and what the government can can do to rein things in, especially with inflation and inflationary pressures continuing to put some pressure on these long-end yields. 30-year yields in Japan also in focus this morning, not immune to the global sell-off, up 4 basis points. They're reacting to news that one of the key LDP lawmakers has decided to step down, so political uncertainty weighing on the long end of the curve. 30-year yields we spoke about in the U.S. getting closer to 5% as well. The pound slipping this morning, too, after a sell-off of more than 1.5% yesterday in trade. Again, focus on those UK assets, and then euro declining a little bit. Let's switch over and take a look at some of the Asian markets as well. The handover from Asia, even though we are seeing some stabilization in U.S. futures, not so much the case for some of these key assets in Asia. We have the Hang Seng dropping 0.4%. The China CSI 300 also down about 0.9% as well. The Nikkei 2, that LDP news not helping. Then the Kospi up 0.2%, despite the fact that another directive came out from the U.S. yesterday suggesting that TSMC will have to apply for special licenses to ship to China. That is a similar move that they applied to some of those South Korean chip makers over the weekend. So keep an eye out there on geopolitical developments as well. Now, speaking of political developments, let's switch over to Turkey. A Turkish court has ordered the removal of the main opposition CHP's Istanbul administration, a ruling likely to disrupt the party as it tries to mount a challenge to President Recep Tayyip Erdogan. The decision caused local markets to slump, with the benchmark BIST 100 closing down and government bond yields soaring. And there you can see that the index closed down 5.7%. This is its worst day since back in March, when the original crackdown against the Istanbul mayor took place. So joining us now is Beryl Akman, Bloomberg's Turkey deputy bureau chief. Maybe, Beryl, let's just start with the significance of this court ruling. And what does it say more broadly about the future of the main opposition party, the CHP?
Morning, Jumana. I think to understand the importance of this case, we need to look at it from 2 points. One, just like you mentioned, we have seen a broader crackdown, a judicial crackdown against the main opposition party since the start of the year. And that had reached an unprecedented climax when Istanbul Mayor Ekrem İmamoğlu, who was largely seen as the strongest rival against President Recep Tayyip Erdogan, was jailed on alleged corruption charges. Now, the CHP says that these cases, as well as the one yesterday, the ruling yesterday, is politically motivated. And it is the government's, which they alleged is the government's efforts to disrupt their momentum that they had seized since the local elections last year, when they showed a massive landmark success. And in polls, they were showing against Erdogan's ruling AK Party. So this is seen by them and by critics as sort of an effort to divert from that. At the same time, though, this case is critical because of its timing. Now, the CHP's leadership, including Chairman Özgür Özel, who was largely behind the successes in local elections last year, and in the momentum we have seen over the last few months, is facing a risk of being unseated from that leadership in a case due on September 15. So analysts and investors yesterday were worried that the ruling yesterday could be seen as an indicator of the fate for Özel and his administration in the next weeks.
And is that why the market reacted in such a way so negatively, both in equity space and in bond yields, because of serious concerns about how this is always going to play out and whether there is actually a viable opposition party right now in Turkey?
I think absolutely it definitely ties to the case, the hearing on September 15, when Chairman Özgür Özel of the CHP and his administration could be removed from leadership. And that would definitely reignite or aggravate concerns of democratic backsliding in Turkey, because the fate of that case could result in Özel's predecessor, Kemal Kılıçdaroğlu, who was largely seen as an unsuccessful opposition figure, could be reinstalled, or a government trustee could come back. And that will raise concerns about whether Turkey is sliding more to an authoritarian shift, and where elections in the future could actually have, a meaning. And it was largely, I think, reminiscent of the market turmoil we saw in March when Ekrem İmamoğlu, Istanbul's mayor, was jailed. So it just, I think, is a reminder that there's a political risk and there's risk to investing in Turkey, and we're likely to see more political uncertainty in the coming weeks.
Beryl, thank you so much for breaking it down for us. Beryl Akman, Bloomberg's Turkey Deputy Bureau Chief. Thanks. Now, Japanese bonds are sliding alongside global debt as heavy corporate issuance and budget worries weigh on European securities and treasuries. Joining us now is Nicolo Bocchin, the global head of fixed income at Azimut Group. Good morning to you, Nicolo. Good to have you with us. Let me start off by asking whether you think that the sell-off that we had yesterday, globally, by the way, I know that the UK caught a lot of attention, but there was a global fixed income sell-off. Is the catalyst fiscal concerns, or is it just more classic return to September and the fact that there was so much corporate issuance that hit the markets yesterday, both in US and in Europe?
I believe it is a mix of everything. September, October normally are months where you have a lot of issues to be digested globally. But it's part of a trend that started a while ago, and it is the same happened in Japan, in Europe, in UK, in US, which is a repricing of the risk premium. Either now on the long end or very long end of the yield curve globally are compensating a lot more compared to the past for the risk that investors have to face while investing in long-term bonds. Is it enough? Is it not enough? Who knows? But it's clear that compared to the past, now we have a lot of risk premium embedded in the fixed income space.
And where is that risk premium embedded? Where is it coming from, I should say? What is it accounting for? Why are investors demanding that extra premium to own longer duration bonds?
I call it normalization. Due to liquidity, we had a lot of liquidity in the past, injected by central banks multiple times across the globe, which created a distorted environment where you had a zero risk premium in the long end of the yield curve, but in the context of very low inflation. Now we are in an environment where inflation is 2% plus across the globe. And liquidity has been drained by central banks through QTs, but at the same time, there has been new safe havens like cryptos, like gold, that drain even more liquidity from the fixed income space. This is how I explain the current shape of yield curves and the current dynamics in the mid to long end of that space.
Yeah, at what level? Maybe let's just start with U.S. Treasuries and pin it down there. 30-year yields are approaching 5%. U.S. 10 years are still around 4.3. At what level do you think we may start to see things stabilize and actually see buyers step in?
To me, the buying spree should have started basis points away. So to me, the environment is very attractive now. It's hard to say where it would stop. But to me, when I have an environment compensating for growth, inflation expectation, and an average risk premium attached to it, is not a reason to say no. Why not? Why not buying now? That's the point. And given to me the inflation environment will cool down even further down the road, it makes a lot of sense to invest in longer bonds at this point in time.
Yeah. So you're talking to us from Bologna, so Italian. Let me ask you about something that many people have been talking about, which is this observation that 10-year French bonds are very close to overtaking 10-year BTPs in yield terms. Do you think that is valid, or would you take the other side of that?
I love Italian bonds, not because I'm Italian, but because it's one of the few countries in the world showing finally some political stability. There is a sort of fiscal discipline. We are flush with liquidity, and private wealth is extremely high. So there is more value probably in Italian bonds than in other bonds like the French ones. Having said that, France will have a government sooner or later. Yes, they have some pressure on the fiscal side, but the current negativity to me has gone too far, I would say.
Yeah. Okay, so just to round things up then, can European fixed income duration perform in an environment where the ECB have essentially said that they've done enough at this point, that the rate cutting cycle is for the foreseeable future over?
We have to believe that fixed income it can be boring. Bonds need a lot of patience. And you cannot expect capital appreciation. Now, the story with fixed income is just clipping my coupons at times where the yield curve is extremely steep. I can expect to have an environment where inflation will be lower a few quarters from now. So even the ECB saying 2%, I will not go lower than that, we will see. Because at the end of the day, it's still the macro picture that counts. And to me, growth risk remaining anemic, and inflation, you cannot afford inflation to fall below 2%. That's the point. So I wouldn't exclude measures like ending QT or thinking about more cuts going forward. But it's all about macro dynamics.
As always, everything comes back to macro. Nicolo Bocchin, Global Head of Fixed Income at Azimut Group. Thank you so much. Now for a look at some of the other stories we're following. The U.S. has revoked TSMC's waiver to freely ship essential equipment to its key chip-making base in China. Suppliers must now seek individual approvals to ship gear to the Nanjing facility, potentially disrupting production. The move mirrors actions taken against Chinese facilities operated by Samsung and SK Hynix. Alphabet shares surged after the bell following a U.S. judge's ruling that Google won't have to sell Chrome but must share some search data with rivals. The judge also banned Google from exclusive search deals but allowed it to continue making payments to third parties. Google has flagged privacy concerns over the antitrust ruling and says it does not monopolize the online search sector. And coming up, Saudi Arabia is launching its first residential mortgage-backed securities in a bid to boost liquidity. We're live from Riyadh next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Saudi Arabia has launched its first residential mortgage-backed securities in a move designed to boost liquidity and encourage more bank lending. The kingdom is looking to fill financing gaps and bring in cash to support the Crown Prince Mohammed bin Salman's diversification drive. Let's go to Riyadh now and speak to Christine Burke, Bloomberg's Saudi bureau chief. This feels like a really big deal, so maybe just walk us through the significance of the launch of the RMBS market and why now?
Yeah, you're right, Jumana, and that this is a significant deal. So Saudi has been looking for quite some time on launching asset-backed securities or opening up this market. But what we saw a couple of weeks ago is that it granted regulatory approval for the first time to issue RMBS to a company called Saudi Real Estate Refinance Company. Now, this is a company that is owned by the Public Investment Fund. So, a lot of credibility there. And what SRC did was carry out its first RMBS transaction last week. Now, we don't know the size of the deal. We don't know the structure of the deal or who exactly was involved just yet, but SRC has signed deals with some big names over the last year to work on RMBS. That includes BlackRock, Saudi pension fund manager Hassana, and also King Street. So presumably some of them are involved. And the reason why this is so significant and the reason why it's significant right now is this really should free up some space on banks' balance sheets in order for them to generate more loan growth. Bloomberg Intelligence says that banks could transfer about $48 billion worth of their mortgages over to SRC. So then SRC can then package them and sell them into the market. And this could result in a $23 billion investment opportunity. And this is so important at the moment because Saudi is really in need of cash. And in any way you cut, slice, and dice it, there's so much spending and investment going on for the Vision 2030 agenda. So really, this is just one way to not only boost liquidity in the market, but help banks free up space to lend more.
Yeah, absolutely, on the liquidity side of things. But speaking of funding, so it looks as though Saudi have gone to the market with a 5-year and a 10-year sukuk. We're just getting some updates now on some of the pricing terms. The 5-year coming at a spread of 65 to treasuries, the 10-year coming at a spread of 75 to treasuries. So Saudi Arabia, the sovereign, back in the market with this bond placement.
Yeah, I mean, this should not be surprising. Saudi Arabia has been one of the most active sovereign issuers in emerging markets. So, yes, we saw them come to the international bond market yesterday. You mentioned the details there, a 5-year, a 10-year. We don't know the exact size of the deal just yet, but as of midday yesterday, there were book orders in for more than $17 billion. So clearly the demand is out there. And there is some early terminal data today suggesting that the bond sale could be in the range of about $5.5 billion. And that's significant because the kingdom has already issued in international bond markets almost $15 billion this year, making it the #1 issuer in emerging markets. So you add another $5 billion to that, or whatever the final figure may be, and you have a very active sovereign here. And the reason that they are doing this is, of course, we're seeing lower oil prices that are squeezing the kingdom's finances. The government is running deeper budget deficits. Spending needs are just going higher. And so the kingdom has widely telegraphed that it plans to continue issuing debt in order to fill the funding gap and the financing gap that it is seeing, of course, again, as the kingdom tries to drive the Vision 2030 agenda that requires so much investment in every corner of the economy.
Yeah, as you and the team have been following very closely. Chrissy, always good to chat to you. Thank you so much for bringing us that news, big news out of the kingdom with the launch of the potential bigger RMBS market. So Christine Burke, Bloomberg Saudi Bureau Chief, breaking it down for us. Now for a look at some of the other stories we're following. Bloomberg Economics estimates that Israel's economy is 7% smaller than it would have been without the war. That blow is on par with the U.S. during the global financial crisis. Before, Israel used to grow 4% annually, but now growth has collapsed to 0. Since October 2023, that slump has compounded into a 7% shortfall, equal to about $4,000 for every Israeli citizen. Israel has reportedly begun mobilizing tens of thousands of reservists and repeated evacuation warnings on Tuesday as part of its plan to widen its offensive in Gaza City. The call-up comes as ground and air forces press forward and pursue more targets in northern and central Gaza. Israel says Gaza City is still a Hamas stronghold where the militants have a vast tunnel network despite multiple incursions throughout the war. The move to take over the rest of the enclave has sparked opposition domestically and abroad. And coming up, we hear from the CEO of Africa's largest supermarket chain on strategy for South Africa and the rest of the continent. This is Bloomberg.
It wasn't easy. It wasn't decisions that was taken lightly, but the rest of Africa had become a story of currency devaluations and high inflation, and that have started to create quite a lot of pressure on us in terms of supporting those countries, and so much so to the point that, and to a large degree, a lot of the countries was subsidized from this African business. So yes, it wasn't easy. We've still got a main portion of non-RSA countries, they are mostly southern based or neighboring countries to South Africa. And with that portfolio, we are very happy. You will see we are getting closer and closer to the medium-term profitability that we said we can achieve out of that core base of countries this year, increasing the profit of that segment to 644 million.
What does that mean then for the rest of Africa strategy for Shoprite? Do you focus then on just Southern Africa and the neighboring countries to South Africa?
At the moment, I can confirm there is no country, African country, that I'm planning that we should enter or re-enter, but I'm definitely not excluding it. I'm keeping my eyes open. We would love to go back into and expand our non-RSA business under the right conditions. We may adapt our formula in which we might do it, the model that we do. Now that we are a true omni-channel retailer, that opens different opportunities, and we are still definitely on the lookout when there is any green shoots, stabilities, settling of currencies, etc., ease of trade, then we will definitely look at it to expand the geographic areas into the continent.
That was Peter Engelbrecht, CEO of Africa's largest supermarket chain, Shoprite, speaking to Jen about exiting some African markets as risks accumulate. Well, let's pick up on how markets are faring. Big global rout yesterday for both fixed income and equities, but things are stabilizing this morning. S&P futures leaning towards the green, marginally so, up 7 basis points. Nasdaq also up 22 basis points too. We're going to keep a close eye on how fixed income develops throughout the course of the day. A lot of focus on UK gilts yesterday, with the long end back to levels not seen since 1998. This is 10-year yields as well. Keep a close eye on 30-year, which is approaching 5%. That is it for Horizons Middle East and Africa. I'm Joanna Bersecci in Dubai. Stay with us for Daybreak Europe.